How a long-term care annuity works. Long-term care is one of the biggest financial risks retirees face. Many people do a great job saving for retirement, but one extended health event, such as needing home care, assisted living, or nursing care, can quickly drain assets and put a surviving spouse in a difficult situation. That's where a long-term care annuity can help. And long-term care annuity is designed to turn a portion of your savings into a larger pool of money that can be used for long-term care expenses, while still giving you growth potential and access to your funds. Here's how it typically works. Step 1. You deposit money into the annuity. A single person or married couple may choose to deposit $200,000 into a long-term care annuity. That money is then credited interest based on the annuity strategy. The account can earn a competitive rate of return, usually minus a fee, depending on the specific product design. Over time, as the account earns interest and grows, the value of the annuity may increase. Step 2. Your long-term care benefit is typically much larger than your deposit. One of the biggest advantages of a long-term care annuity is that it can create a long-term care benefit that is larger than the money you put in. In many designs, the long-term care benefit is often around 3 times the annuity value. So if a couple deposits $200,000, the initial long-term care benefit may be $600,000 available for long-term care expenses. This benefit can help pay for qualified long-term care costs such as home health care, nursing home care, assisted living, memory care. This is important because the cost of care can be extremely high, and it's one of the main reasons retirements become financially stressful. Step 3. As the account value grows, the long-term care benefit can grow too. Another key feature is that as the annuity earns interest and grows, the long-term care benefit usually increases as well. In other words, as your annuity value increases, your long-term care benefit can increase too. This can be helpful because long-term care costs tend to rise over time. A benefit that has the ability to grow can help keep pace with future expenses. That's also why it's often better not to take withdrawals unless necessary. When you leave the annuity untouched, the account value has a greater chance to grow, and in many cases, the long-term care benefit grows along with it. The more the account can grow, the more protection you may have available if long-term care is ever needed. Step 4. If long-term care is needed, benefits are paid out. If the client ever needs long-term care, the annuity can begin paying benefits, often as monthly payments, until the long-term care benefit is used. This provides retirees with a way to pay for care without draining retirement savings, selling investments at the wrong time, or placing the entire burden on family members. Access to your money. The 10% free withdrawal feature most long-term care annuities are designed to give you flexibility and access. In many cases, you can withdraw up to 10% per year of the annuity value without a surrender penalty. Example: if you deposit $200,000, you may be able to withdraw up to $20,000 per year without any surrender charge. This can help if you need emergency cash, income flexibility, money for unexpected expenses. However, since withdrawals reduce your account value, they may also reduce future growth potential, and depending on the product, they can reduce the long-term care benefit as well. The 10-year penalty period. How it works. Most long-term care annuities also include a surrender period, which is commonly 10 years. This does not mean your money is locked up completely. It simply means the annuity is designed for longer-term planning. During this surrender period, if you withdraw more than the 10% free withdrawal in the early years, the insurance company may charge a surrender penalty on the amount above the free limit. The surrender charge typically starts higher in the first year and gradually decreases each year until it reaches zero at the end of the 10th year. After the surrender period ends, the annuity is usually available with no surrender charges. Simple example: if you deposit $200,000, you may be able to withdraw $20,000, 10%, with no penalty. But if you take $50,000, the surrender charge may apply to the extra amount. So, $20,000 equals no penalty. $30,000 equals may have surrender charges depending on the year. Important note: health questions are usually required. Unlike many standard annuities, most long-term care annuities require underwriting. That means the insurance company will usually ask health questions, and sometimes request additional medical information to determine eligibility. This is because the long-term care benefit is based on the likelihood of needing care in the future. Why many retirees like this strategy? And long-term care annuity can be attractive because it creates a large pool of long-term care benefits using existing savings. It helps protect a retirement plan from being destroyed by care costs. It offers growth potential while providing protection. It provides flexibility through free annual withdrawals. It allows your long-term care benefit to grow larger when withdrawals are minimized. The bottom line, long-term care isn't just a healthcare issue, it's a retirement income issue. For retirees who want to protect their assets and plan for long-term care in a better way, an LTC annuity can offer an effective solution. It turns a portion of savings into a larger long-term care benefit, provides growth potential, gives access to funds, and helps protect the entire retirement plan from one of its biggest threats. Thank you. Important disclosures. For educational purposes only, please consult with a licensed professional. Guarantees are backed by the claims-paying ability of the issuing insurer. Product features, fees, and availability vary by carrier and state. Most contracts have a surrender charge period, often 10 years. Withdrawals beyond free limits, commonly 10% annually, may incur charges and may reduce benefits. Withdrawals before age 59.5 may be subject to a federal tax penalty. LTC benefits are subject to eligibility requirements and underwriting health questions. Not all applicants qualify. In Florida, annuity recommendations must meet suitability and best interest standards based on the client's needs and financial circumstances. We are ready to assist you.